What if every major financial collapse in history was never a random accident, but a predictable stage in a repeating cycle that we are watching unfold right now in the United States? When you look closely at Tulip Mania in the 1630s, the South Sea Bubble of 1720, and the Enron meltdown in 2001, you begin to see the same hidden engine driving all of them, a six-stage financial cycle that always starts quietly, builds dangerously, and then detonates with the exact same psychological triggers. And here is the uncomfortable question that opens everything. If this cycle has already destroyed nations and corporations for 400 years, why would the United States suddenly be the exception? Every collapse begins with the illusion of stability, that deceptive moment when markets rise, optimism spreads, and investors believe the rules have changed. Confidence turns into speculation, speculation turns into leverage, and leverage becomes the fuel that feeds the bubble from the inside. This is the early stage most people ignore because nothing looks dangerous on the surface. Prices rise, liquidity increases, and everyone feels smarter than they really are. That is the same mood that preceded the absurd rise of tulip bulbs, the impossible profits promised by the South Sea Company, and the fabricated numbers that Enron fed to Wall Street. And today, you can feel echoes of that same psychological atmosphere in the American market, where asset inflation, corporate debt expansion, and unrealistic growth expectations create a perfect breeding ground for distortion. But the real danger begins when optimism shifts into collective delusion. Investors stop asking questions. Institutions abandon discipline. Corporations rewrite their own narratives. You start to see momentum replacing logic and hype replacing fundamentals. This is the transition moment in every historical bubble, and the United States is deeply embedded in it, moving through the financial cycle exactly as past collapses did. The warning signs are everywhere, but most people do not want to believe them. Just like they refuse to believe a flower could crash an economy, a monopoly could break an empire, or a single corporation could vaporize billions overnight. And as you let this sink in, take a moment to reflect on how this cycle touches your own experience. Have you ever felt that strange sensation that something in the financial system does not add up? That the numbers look strong, but the foundation feels weak? That is why understanding this pattern matters. Leave a comment sharing your thoughts or your own experience with financial bubbles. And do not forget to like this video and check if you are already subscribed to the channel. Because what comes next in this cycle may surprise you as we move into the next stage of the story, where the cracks beneath the surface begin to widen in ways most people never see coming. When the first cracks begin to form beneath a growing bubble, they rarely announce themselves with dramatic headlines or sudden crashes. Instead, they appear quietly, almost politely, like faint tremors under the surface of a seemingly solid structure. This is the early stage of every financial cycle, the moment when distortions start to build in silence, while the crowd convinces itself that nothing could possibly go wrong. Investors, institutions, and policymakers all behave as if optimism were a shield against reality. And this is the precise mechanism that powered the earliest phases of Tulip Mania, the South Sea frenzy, Enron's artificial success, and now the expanding vulnerabilities inside the United States economy. The emergence of a bubble always begins with something small, a new opportunity, a new technology, a new commodity, or a new narrative that captures public imagination. In the tulip markets of the 1600s, it started with a rare flower mutation. In the South Sea Company, it was the promise of untapped global trade. In Enron, it was the illusion of revolutionary corporate innovation and limitless growth. In each case, the story was believable enough, compelling enough, and profitable enough to create a gravitational pull. People didn't fall into these bubbles because they were foolish. They fell in because the narrative was irresistible. As confidence spreads, markets stop behaving like markets and start behaving like echo chambers. Prices rise not because value rises, but because belief rises. And belief becomes a self-reinforcing force. Investors begin chasing returns rather than evaluating risk. Institutions start stretching their assumptions, and leverage grows quietly in the background. What begins as a rational pursuit of opportunity mutates into a collective performance, where everyone is pretending to understand what they are actually guessing about. This is where the seeds of collapse are planted, long before anyone realizes the soil has already shifted. What makes this phase so dangerous is that it feels good. Rising prices create the illusion of competence. People believe they are participating in a rare window of opportunity, something special, something that will not come again. Asset bubbles feed on human psychology, especially the need for validation. Once a few early investors succeed, others feel pressure to join. Once institutions participate, the public follows. Once governments rely on inflated markets for growth projections, the entire system synchronizes around the bubble itself. This same early-stage phenomenon is visible in the United States today. Asset valuations stretch beyond fundamentals. Corporate debt expands even as productivity lags. Consumers borrow more while savings decline. Speculative investments attract mass participation. And each of these signals resembles the same beginnings found in every previous financial cycle. What looks stable is often only balanced because everyone is leaning in the same direction, unaware that stability built on excessive confidence is the most fragile stability of all. And as this quiet, upward drift continues, something far more subtle begins to happen. The system forgets its own vulnerability. Historical memory fades. Caution is seen as pessimism. Risk management becomes an afterthought. This is the invisible transition that moves a bubble from formation to acceleration, and it always precedes the moment when psychology becomes more powerful than economics. It is inside this transition that the next stage of the cycle quietly waits, gathering momentum before it finally reveals how quickly optimism can turn into fear when the illusion of control begins to slip. As optimism mutates into collective momentum, the financial cycle quietly moves into one of its most dangerous phases, the psychological acceleration that transforms mild speculation into unrestrained mania. This is the point at which markets stop responding to fundamentals and begin responding exclusively to emotion. It is not numbers that drive decisions now, but the fear of missing out, the pressure to keep up, and the intoxicating belief that the upward trend will continue simply because it has continued until now. This psychological shift is the same engine that once inflated the tulip trade to impossible heights, that sent South Sea shares skyrocketing on pure imagination, and that allowed Enron to mask its hollow core behind a narrative of endless growth. Panic does not begin with fear. Panic begins with the illusion that fear no longer matters. Investors convince themselves that they understand the risks, that volatility is just noise, that the market has evolved beyond traditional limits. This confidence becomes a kind of collective hypnosis, where everyone mirrors the behavior of everyone else, interpreting momentum as confirmation rather than distortion. During Tulip Mania, buyers believed rarity justified irrational prices. During the South Sea frenzy, the public believed monopolistic access to trade guaranteed permanent profit. During Enron's rise, analysts believed new financial instruments made old metrics obsolete. In each case, psychology outran reality, and the crowd followed. As the bubble grows, the narrative becomes institutionalized. Media coverage amplifies optimism. Analysts raise targets to justify rising valuations. Corporations exaggerate potential gains to attract investors. Governments celebrate the illusion of prosperity because inflated. Markets support political stability. The entire ecosystem becomes synchronized around enthusiasm. And once that happens, dissenting voices are not debated. They are dismissed. Rational warnings are labeled as negativity. Risk assessments are ignored, and markets become increasingly detached from the very conditions that once anchored them. This psychological environment has a predictable consequence. People stop assessing what something is worth and begin paying for what they think someone else will pay. Markets turn into reflexive loops, where price movements feed expectations, and expectations feed further price movements. What was once investing becomes a chain reaction of speculation. This transformation is subtle, but once it takes hold, it changes everything. The bubble no longer needs real value to grow. It only needs belief, and belief spreads faster than any economic principle ever could. We see this exact reflexive pattern emerging in the United States today. Asset prices surge even as economic fundamentals weaken. Speculative markets attract participants who admit they do not fully understand what they are buying. Financial influencers, media platforms, and institutions repeat narratives designed to maintain confidence. Corporations rely on perception rather than performance, and consumers behave as though cycles no longer apply. This is the psychological tipping point, where emotional momentum becomes the dominant force shaping financial behavior. But beneath this frenzy lies the pressure that eventually triggers panic. When prices have risen too far, when leverage has grown too large, when expectations have become unrealistic, the smallest disruption can shift sentiment. It might be a disappointing earnings report, a sudden interest rate change, a geopolitical shock, or even a rumor. And once sentiment turns, it turns quickly, because markets built on confidence are destroyed by doubt. That doubt is the spark that transitions the system into the next stage of the cycle, where the illusion of control begins to fracture, and the structure that once seemed unbreakable starts to reveal how vulnerable it truly is. When the psychological momentum that fuels a bubble finally begins to weaken, the financial cycle enters stage 4. The moment when confidence quietly fractures, and the structure supporting the entire system begins to shift under its own weight. This stage is never immediately recognizable. There is no dramatic crash, no sudden catastrophe, no headline that announces the turning point. Instead, it starts with subtle inconsistencies, small mismatches between expectations and reality, the kind of discrepancies that would normally be dismissed if the system were still healthy. But in a bubble fed by belief rather than fundamentals, even small cracks carry enormous meaning. Stage 4 is where the illusion of stability begins to erode. Investors notice earnings that do not align with valuations. Lenders become more cautious. Institutions start reevaluating the risks they previously ignored. Markets react hesitantly to news that would have once triggered enthusiasm. This is the moment when the collective emotional energy that pushed prices upward starts losing its force, and for the first time, participants sense that the ground beneath them may not be as solid as they thought. In historical cycles, this phase was always present. During Tulip Mania, buyers suddenly realized there were fewer willing participants at higher prices. During the South Sea collapse, investors began questioning the company's exaggerated promises. During Enron's unraveling, analysts finally noticed accounting irregularities they had overlooked for years. In each case, the shift was quiet but decisive. What makes this phase so dangerous is that it disguises itself as normal market fluctuation. People interpret the hesitation as temporary, as a healthy correction, as a chance to buy the dip. They reassure themselves that cycles always include minor pullbacks. But beneath this comforting interpretation lies a deeper truth. Once confidence starts slipping, it rarely stops on its own. Markets built on perception rely on a kind of shared faith, and once that faith weakens, everyone looks to everyone else for reassurance. When reassurance does not come, the psychological balance flips from optimism to caution. In the United States today, signs of stage 4 are increasingly visible. Corporate debt is rising faster than earnings. Consumers rely heavily on credit despite shrinking purchasing power. Asset valuations remain stretched even as economic indicators soften. Banks tighten lending standards. Investors rotate into safer assets. These are not symptoms of collapse, but early signals that belief is losing strength. The system has not broken, but its internal pressure is changing. And when pressure shifts in a speculative environment, it creates vulnerabilities that accumulate more quickly than most people realize. Stage 4 is the silent turning point of every financial cycle. It is the moment when the narrative loses coherence, when confidence becomes harder to maintain, and when the system begins preparing, quietly, invisibly, for what comes next. The transition from enthusiasm to uncertainty is subtle, but once it starts, it sets in motion dynamics that cannot be reversed by wishful thinking, policy statements, or temporary rallies. What follows is shaped not by fundamentals, but by how quickly doubt spreads when the crowd begins sensing that the cycle is no longer working in their favor. As confidence weakens and the financial cycle drifts deeper into instability, historical patterns become clearer, almost as if the past were whispering warnings that most people still refuse to hear. Tulip Mania, often romanticized as an oddity of economic history, was in fact the first major demonstration of how quickly a speculative system unravels once belief begins to slip. Its collapse was not the result of a single dramatic event, but rather a gradual shift in sentiment that exposed how fragile the entire structure had become. And this is why Tulip Mania remains one of the most important lessons in understanding the nature of Stage 4. It reveals how a seemingly unstoppable market can fall apart the moment expectations collide with reality. In the early months of 1637, buyers who once competed fiercely for bulbs began to hesitate. Not reject, not panic, just hesitate. Prices stopped, rising with the same force. Fewer participants were willing to enter new contracts. Some traders began requesting physical delivery instead of relying on promises. These tiny changes in behavior were enough to destabilize a market built entirely on anticipation. Tulip Mania teaches us that bubbles do not burst because prices reach a certain height. They burst because the psychology holding them up loses coherence. Once that coherence weakens, every participant starts evaluating risk differently, and the chain reaction begins. The collapse, when it came, unfolded with brutal speed. Buyers vanished overnight. Contracts became worthless. Bulbs that had traded for the price of a house could not be sold for the price of a loaf of bread. The tulip market exposed a truth that still applies today. Markets driven by speculation do not descend gradually. They break suddenly, because speculation relies on a continuous line of buyers, and when that line snaps, everything beneath it collapses. This same dynamic exists inside modern financial systems, even if the assets have changed from flowers to stocks, bonds, or derivatives. What mattered then is exactly what matters now, the moment when confidence stops expanding. More importantly, Tulip Mania demonstrates how illusions of value can infect an entire economy. Even people who were not directly invested depended on the bubble indirectly, through merchants, lenders, and trade networks. When the tulip market imploded, its shockwaves rippled through Dutch society, tightening credit conditions, weakening trade, and undermining trust in financial contracts. And this broader impact mirrors a key characteristic of every major bubble. The damage is never limited to those who speculated. When confidence collapses, the consequences expand outward. Looking at today's environment through the lens of Tulip Mania reveals unsettling similarities. Markets driven by momentum rather than fundamentals. Assets priced beyond any realistic expectation of return. Investors relying on future buyers rather than intrinsic value. And beneath all of it, subtle shifts in sentiment that hint the system is not as stable as it appears. These echoes of the past matter because Tulip Mania shows the earliest form of the mechanism that still governs every financial cycle, the delicate balance between belief and doubt. And once that balance begins to tilt, the system naturally progresses toward the next phase, where pressure intensifies and the unraveling accelerates in ways most participants are never prepared to face. As the financial cycle advances, the pressure building beneath the surface becomes impossible to ignore, and the system enters a phase where the scale of the bubble no longer depends on isolated speculation. It becomes institutional. This is the stage that turned the South Sea Company from a promising commercial venture into one of the most spectacular financial collapses in history. The South Sea bubble is not just an old story about misguided investors. It is a blueprint demonstrating what happens when greed aligns perfectly with government incentives, market enthusiasm, and unchecked corporate manipulation. And in many ways, this stage reflects the same structural weaknesses that appear in every major bubble, including the one forming in the United States today. The South Sea Company built its empire on a promise: exclusive trading rights with Spanish South America. This promise was enough to spark imagination, but not enough to justify the explosive valuations that followed. Investors didn't buy South Sea shares for the profits the company was actually generating. They bought them for the profits they hoped it might generate someday. This is the essential pattern of Stage 6 in the historical cycle: speculation disguised as opportunity, and opportunity amplified into national obsession. As share prices soared, the company used the momentum to manipulate its own value. Directors issued optimistic statements, exaggerated future prospects, and designed schemes that encouraged the public to reinvest their paper gains directly back into the company. Banks, politicians, and wealthy elites joined the frenzy, creating an ecosystem in which skepticism evaporated. The bubble no longer needed the fundamentals of trade or profit to sustain itself. It was now driven by a massive apparatus of belief, reinforced by institutions with the power to shape perception. This stage is crucial because it reveals how bubbles transform from collective illusions into systemic vulnerabilities. When governments support or rely on inflated asset prices, the bubble becomes embedded inside the national economy. In the case of the South Sea Company, the British government itself became entangled, encouraging the public to buy shares and granting the company privileges in exchange for debt restructuring schemes that temporarily patched fiscal problems. This political alignment amplified the mania and made the collapse far more destructive when it eventually came. When the truth surfaced that the company could not generate the wealth it promised, the bubble imploded with devastating speed. Parliament panicked. Banks tightened credit. Investors tried to exit the market simultaneously. Lives were ruined, fortunes evaporated, and public trust in institutions was shattered. What makes the South Sea collapse so important is not the magnitude of the losses, but how closely the psychological and structural sequence mirrors every financial crisis that followed. A compelling narrative replaces fundamentals, institutions reinforce the illusion, and the public accepts unsustainable valuations because doing so feels safer than questioning them. Today, similar mechanisms operate across modern markets. Corporations rely on inflated projections. Governments depend on rising asset values to maintain economic stability. Investors treat momentum as validation. And beneath this coordinated enthusiasm lies the same systemic fragility that defined the South Sea era. The specifics have changed. Stock tickers instead of handwritten ledgers, digital markets instead of crowded coffee houses, complex financial instruments instead of simple shares, but the underlying mechanism is unchanged. As institutions align with speculation rather than discipline, the cycle advances inevitably toward the next stage, where cracks exposed earlier expand into full structural failures, revealing how deeply the illusion had penetrated long before anyone dared to confront it. As the cycle intensifies, the cracks that were once subtle begin to widen, and the illusion carefully constructed by institutions starts to fracture under its own weight. This is the stage where fraud, manipulation, and structural weakness, once hidden behind optimism and narrative, finally surface. Enron stands as the clearest modern example of this moment in the financial cycle, a case where the collapse did not begin with numbers, but with the realization that the numbers themselves were fiction. Enron shows how far a system can drift from reality when confidence, institutional reinforcement, and public belief create an environment where deception is not only possible, but rewarded. At its peak, Enron was celebrated as one of the most innovative and successful companies in the world. Analysts praised its brilliance. Politicians celebrated its leadership. Investors trusted its ever-rising stock price as proof of its legitimacy. But beneath that admiration was a structure so fragile that the slightest scrutiny could have shattered it. Enron wasn't profitable. It was performing a theatrical illusion of profitability. Its revenues were fabricated through creative accounting, its debts hidden in off-balance sheet entities, and its growth fueled not by business fundamentals, but by the psychological force of belief that had overtaken the market. This stage of the cycle exposes a critical truth. When markets become dependent on perception, deception becomes a rational strategy. Enron's executives understood that as long as confidence held, no one would question the company's increasingly unrealistic valuations. Banks continued lending, investors continued buying, analysts continued praising. This institutional complicity mirrored the psychological momentum that once elevated tulip bulbs and South Sea shares, proving that the mechanism is timeless, even if the assets change. Enron's rise was not an anomaly. It was the predictable manifestation of a cycle pushed too far. When the truth finally emerged, it didn't reveal a sudden collapse. It revealed a collapse that had already happened long before anyone saw it. The company's valuation evaporated in days. Employees lost their retirement savings. Markets reeled as investors realized how deeply the deception had spread. Enron demonstrated that fraud isn't the cause of collapse. It is the symptom of a system that has moved so far from fundamentals that illusion becomes essential for survival. And once illusions fail, the cycle accelerates toward its most violent phase. Today, similar conditions can be observed across sectors of the United States economy. Corporate valuations dependent on expectation rather than performance. Debt structures reliant on perpetual optimism. Institutions that reinforce narratives because stability depends on belief, not data. These are the same psychological and structural forces that allowed Enron to rise unchecked, and they signal that the current cycle may already be deeper into vulnerability than most people realize. Enron's collapse is not just a corporate failure. It is a warning of what happens when a financial system's strength comes from confidence rather than substance. Once confidence erodes, the deception that once held the system together becomes visible, and the unraveling that follows is both rapid and unavoidable. This is the moment the cycle begins transitioning toward its final stages, where the consequences spread far beyond the institutions that created the illusion. As the cycle advances beyond the exposure of structural deception, a deeper and far more unsettling truth begins to emerge. These financial collapses are not isolated events, nor are they anomalies caused by rare circumstances. They are the direct result of a repeating pattern built into the architecture of economic systems themselves. When fraud becomes the logical byproduct of a market addicted to constant growth. When speculation becomes normalized and when institutions rely on inflated valuations to maintain stability, the stage is set for a collapse that mirrors every major crisis in modern financial history. And this is the point where the United States begins to resemble not just a single past disaster, but all of them at once. The American financial system today shows the same psychological, structural, and behavioral signatures that appeared in the Dutch Republic before Tulip Mania collapsed, in Britain before the South Sea Company imploded, and in the U.S. corporate world before Enron collapsed from within. These are not vague similarities. They are precise echoes. Unchecked speculation. Government dependence on rising asset prices. Corporate balance sheets engineered to impress rather than inform. Households leveraging themselves deeper into debt. Institutions assuming perpetual expansion. Each of these elements existed before major collapses throughout history, and each of them exists now with even greater scale. What makes the current cycle especially dangerous is its complexity. Unlike Tulip Mania, which centered on a single commodity, or the South Sea Bubble, which revolved around a single company, or Enron, which was contained within corporate boundaries, the modern American bubble is systemic. It spans equities, real estate, consumer credit, corporate debt, government borrowing, and speculative markets that did not exist in earlier eras. The expansion of financial engineering, derivatives, and digital speculation means the vulnerabilities are interconnected in ways that amplify rather than diffuse risk. Moreover, the optimism supporting this system is not merely widespread, it is institutionalized. Pension funds rely on elevated market valuations to meet long-term obligations. Governments rely on borrowing to sustain spending. Corporations rely on cheap credit to finance operations. Consumers rely on debt to maintain lifestyle stability. Each of these dependencies creates upward pressure on valuations and downward pressure on discipline, accelerating the cycle even as the foundations weaken. And while investors often reassure themselves that the United States is different, history demonstrates that no economy is ever exempt from the consequences of excessive leverage and collective delusion. In fact, the belief that a system is immune to collapse is often the clearest sign that it is approaching one. This was true in the Netherlands, where traders believed tulip prices could only rise. It was true in Britain, where the South Sea Company was perceived as too politically embedded to fail. It was true in the early 2000s, when Enron was seen as too innovative to question. And it is true in America today, where permanent growth is treated not as an aspiration, but as an expectation. As this confidence-driven system continues to expand, small shocks, once inconsequential, gain the power to trigger much larger reactions. A shift in interest rates, a disappointing earnings season, a geopolitical disruption, or a sudden liquidity constraint can expose how stretched the system has become. When these shocks reveal that expectations have outpaced reality, the same psychological flip observed in every past collapse begins to unfold, pushing the cycle toward the point where correction turns into unraveling. The United States is not merely repeating history, it is compressing multiple historical patterns into a single, larger framework. And as the cycle tightens, the forces that once fueled growth now contribute to fragility, priming the system for the transition into the next phase, where the pattern becomes undeniable and the consequences impossible to ignore. As the system moves closer to its breaking point, the similarities between historical collapses become impossible to dismiss. Each crisis may appear unique on the surface, different eras, different assets, different institutions, but underneath, they share the same foundational mechanics. Tulip Mania, the South Sea Bubble, and Enron did not fail because of flowers, ships, or energy contracts. They failed because every financial collapse follows a universal pattern: the detachment from fundamentals, the elevation of narrative over substance, the normalization of excessive leverage, and the slow erosion of trust that eventually transforms instability into inevitability. These common elements form the backbone of the six-stage financial cycle, and understanding them is the key to seeing why the United States now sits precariously in Stage 4. The first universal element is the substitution of story for value. During Tulip Mania, rarity became a narrative powerful enough to override logic. During the South Sea frenzy, the promise of future wealth overshadowed the company's inability to generate real profits. During Enron's ascent, complexity itself became a selling point, allowing the company to hide manipulation behind the illusion of innovation. Today, the United States mirrors this pattern through narratives of endless growth, technological inevitability, and market resilience, stories that sound compelling, but increasingly diverge from the structural realities beneath them. The second element is institutional reinforcement. No bubble grows large without validation from those who should know better. In every historic collapse, powerful institutions played a role in sustaining the illusion. Dutch merchants, British Parliament, global banks, rating agencies, and financial media all contributed to environments where skepticism was discouraged and enthusiasm rewarded. The same dynamic operates today. Policymakers depend on asset inflation. Corporations depend on optimistic projections. Investors depend on low interest rates. Media outlets depend on engagement driven by bullish sentiment. The system reinforces itself until the support becomes circular. The third element is leverage: financial, psychological, and social. Leverage magnifies gains during the rise, but it also magnifies losses during the fall. Whether through speculative contracts in the 17th century, stock subscriptions in the 18th, or off-balance sheet entities in the 21st, bubbles expand because participants increase their exposure beyond what fundamentals justify. The United States now carries record levels of consumer debt, corporate debt, margin debt, and government debt. This creates a structure where even modest disruptions can trigger disproportionate reactions because the system has no margin for absorption. The fourth and most decisive element is the erosion of trust. Every collapse begins with confidence and ends with disbelief. In each historical case, the transition from optimism to fear happened rapidly once participants realized that the narrative they trusted was built on unstable ground. Trust does not erode gradually. It shatters. And when trust breaks, inside a highly leveraged system, selling becomes contagious, liquidity evaporates, and the cycle enters its most violent phase. These repeating elements illustrate why financial crises are not historical accidents. They are structural consequences of how human behavior interacts with economic incentives. And this is precisely why the current American cycle is so concerning. The same psychological distortions, the same institutional complacency, the same overstretched leverage, and the same fragile trust underpin the modern system just as they did in every major collapse before it. As these forces converge, the cycle edges toward the stage where pressure transforms into rupture, and the narrative supporting the system can no longer compete with the reality unfolding beneath it. As the cycle approaches its final stage, the tension that has been quietly building beneath the surface begins to reach a critical point. This is the phase where the structural weaknesses, once hidden behind confidence and narrative, finally converge into a pressure strong enough to reshape the entire financial landscape. Throughout history, this moment has always appeared sudden, as if collapse erupted out of nowhere. But the truth is, that the system had already been deteriorating long before the breaking point arrived. Tulip Mania did not collapse because of a single failed auction. The South Sea Company did not implode because of one disappointing revelation. Enron did not fall because of a single leak. Each was merely the final spark in a structure that had been drying out for years. And today, the United States stands on a similarly precarious threshold, navigating the late stages of a cycle that has repeated countless times before. In this final stage, the financial environment becomes hypersensitive. Small disruptions cause outsized reactions. Liquidity thins. Investors who once felt certain begin to second-guess everything. Institutions quietly reposition. Markets fluctuate, with widening volatility. None of these shifts occur in isolation. They are the visible expression of an underlying transformation. The psychological foundation holding the system together is no longer strong enough to bear the weight of expectations. Once that foundation weakens, the cracks that once seemed contained begin to expand, and the pressure that once felt distant becomes impossible to ignore. And what happens next is not chaos for its own sake. It is the system correcting decades of accumulation. Excessive leverage unwinds. Inflated assets reprice. Narratives built on speculation collapse. Trust resets, not gently, but through a series of abrupt adjustments that force the economy back into alignment with reality. This is the violent recalibration that defined every major financial rupture in history. And although each collapse looked different from the outside, the internal logic was always the same. When a system is built on confidence instead of substance, the cycle always ends with a reckoning. The United States now faces many of the same pressures that mark the final stages of past cycles. Record debt levels, asset valuations disconnected from fundamentals, consumers stretched thin, institutions deeply entangled in speculative structures, a market narrative that feels increasingly fragile. None of these elements guarantee collapse, but together they create the conditions for one. And understanding this pattern is not about predicting an exact moment. It is about recognizing the architecture of risk, the same architecture that has repeated across centuries, across continents, and across every major economic regime. If you have followed this journey through all 10 stages, you already understand the deeper truth. Financial cycles are not random. They are consequences of behavior, incentives, and psychology. And when these forces align in the wrong direction, the outcome becomes a reflection of history rather than an exception to it. The value of recognizing the pattern is not to fear the future, but to see it more clearly, to anticipate the forces at play, and to understand that cycles do not end, they transform. If this analysis resonated with you, take a moment to leave a comment saying, "I'm with you until the end," so I know you followed this journey completely. And if you found real value here, consider subscribing so you don't miss the deeper investigations that build on everything we explored. A like on this video also helps strengthen the reach of this conversation, since the algorithm often hides content that challenges conventional narratives.